Don't fight the Fed. That's the saying, right? And we think that is a good rule. We can see the market uptrends and downtrends having a high correlation to the Fed and their actions. However, the Fed didn't really give us any guidance today. So what do? We don't know where the Fed's going to go. So how do we avoid fighting the Fed, and how do we go with the trend of the Fed? Well, there's a lot of important details the Fed mentioned today, and that's what we're making our decisions and adjustments, because we did make some adjustments today towards the end of that Fed meeting, and we'll discuss those. The first and most important thing, I think, is the Fed's view on the recession. We were concerned about a recession. We're still kind of concerned about a recession, but the Fed is making it somewhat clear that a soft landing is still on the table. They're not seeing anything go too far either direction. Some of the earnings reports have indicated recessionary qualities, but not a hardcore slowdown. So there's a whole lot of things to be concerned about. But what matters, and the way I'm reading this, is the Fed isn't saying a recession is here. The Fed isn't panicking about that. The Fed is not deviating away from their fight of inflation. And them not deviating away from their fight of inflation, and them not being so certain that a recession is something to worry about right now, has taken a little bit of the anxiety out of the aggressive and nearly historic yield curve inversion that we've seen. So we have yield curve inversions that typically indicate recessions, highest levels since, 08, dot-com bubbles. So a yield curve inversion that's indicating a super hardcore recession. We get the Fed saying calm down on that. And then you see the long end of the curve tick up. So this is stuff like TBT, TLT related. We happen to have quite large positions there, and we aren't touching those positions. We're happy we have those positions. 10-year might go up. Conversely, though, we're also taking some of our direct SPY and QQQ protections off. I'm not saying that a mega rally is here. I think that is not going to be the case. I don't want to get to new highs. The economy is not super strong, and it's not growing at a tremendous rate. This is not, also the time to do the opposite of what the recession people feared. But I think expecting a sell-off right now is going to be kind of hard. It's still possible with the 10-year going up, but it would be much more different, for me at least. This is kind of what I was fearing, was Powell saying, we just had our record inflation print. We need to see several consecutive months of declining inflation. Therefore, we're going to do 75 now, and for the foreseeable future, we're going to be on a very hardcore tightening path. He did not do that. He did not give us that forward guidance that I was fearing, and many seem to be fearing. Maybe, I don't know, I'm not going to speak for everyone else, but I was fearing that. That was my concern going into today, because we did have that record print. I don't think oil has bottomed. I think there is, concern for a continued inflation. But he said no, meeting by meeting, we'll take things one step at a time. So we're going to see what happens. For now, I think super aggressive Fed is off the table. They also said talk like they've, front-loaded this. They seem to be suggesting, without trying to give us forward guidance, that they're towards the end of the tightening cycle and the economy is not in a terrible position. I know they've said transitory, it wasn't transitory. We'll see what happens, but that's what they're saying. This is the Federal Reserve, and the saying is don't fight the Fed, so I'm not fighting the Fed too hard. So I think we just have to take a deep breath, not get too ahead of ourselves. Like I said, economic strength means flight to safety can weaken. That's the 10-year, 20-year, 30-year. Those are probably going to poke up. We're seeing that today. Look at the 20-year, TBT. That's going to have an effect. But also, a general alleviating of fears is going to have an effect. It's not a one-to-one correlation, yields, etc. We've had market rallies with higher yields. So I'm not getting too aggressive in the growth. Added a little bit But I'm looking at things more like Intel. Intel's trading at a 6.5 PE. It has a dividend. Just got a massive cash bill to help aid them. That's a stock I'm comfortable buying. I know people don't like it. I know they have their reasons for not liking it, but it's got the setups I like and the setups I'm comfortable with. I'm still concerned about Apple. We will get verdict on that tomorrow. We'll see what happens there. Meta missed. It's coming back off the lows. I'm not touching it either way. So we'll see what happens. I've made some adjustments. I've kept many things still in place. TBT I view as my new hedge, my new protection, which allowed me to feel comfortable getting rid of the SPY puts. Don't need to be so aggressive to the downside. Sold those at a loss. You know, it is what it is. Don't be attached to something just because you have a gain or a loss on it. Price can't dictate sentiment. You have to go with the fundamentals. So I'm seeing a Fed that didn't give us hawkish guidance. I thought they had to do that. Instead, they said, we're committed to getting inflation down, but we think we are into that. We have front loaded, and we kind of know what's going to happen. He said, you know, the dot plot is something to consider, but it goes out of date pretty quickly. We just got to get to the next meeting. So we'll be focusing on things. We're not all in one camp or the other yet. I want to stress that. I'm not trying to be super bullish here. I'm buying stocks. I bought a big Intel position today, but I'm not going all in aggressive, okay? I have quite a lot of exposure to the 20-year going up. Most of my stocks now are materials-based, energy-based, Intel, and then I have sprinkled a little bit of growth on there. I'm talking some CRISPR stocks, but not too many, not nearly the peak. In the last month, we're actually net sellers of CRISPR stocks. So, concerned, but also somewhat less worried. And I think that's how the Fed wants it. I think that's how the Fed wants it. They don't want a mega rally here. They said we don't have as much risk because asset prices are down. I think they like that. I think they like that asset prices are down. They don't want asset prices to go straight up and then for inflation to remain hot and to have a very volatile market because, you know, while I've said everything here about inflation, about their attitude towards it, if we get another hot CPI, well, that'll be not good. Expect the market sell-off on that. If we get a slightly lower CPI and then get a second CPI before the next Fed meeting that is similar to the intra-meeting CPI, that's not good either. That's not consecutive months of declining. That's one consecutive month of declining and then a pause in CPI. So we really just have to pause, see what's happening, take time. I know everyone wants to get super bullish right now, go all in on the leverage cues. I'm not going to do that. You know, I'm not going to do that. It's not me. I think 10 years is going to go up simply because it's down. It's down because of the aggressive fears. You know, it's counterintuitive. We saw European yields come down when they surprised the market with higher than expected Fed hike, ECB hike. You know, some of this stuff's counterintuitive, but yields might go up. That might hurt some things. So the things most exposed to yields going up, we're going to stay away from. Not expecting a mega rally. Stocks are cheaper, but not super cheap. But there are some stocks like Intel that I think are super cheap. I'm comfortable buying those, and I'm comfortable taking off some of the shorts, keeping the Apple specific, almost as kind of an SPY proxy. Also partially concerned about the earnings. We're going to see what happens. That's today's video. Until next time, peace out.